Recording to start. Okay, so now we're going to look at the below the line deductions. And here's our lecture overview. Below the line deductions intro. So this is where we are in the income tax formula. Always ground everything that you learn in the income tax formula. It will really help keep things straight. So we've gotten down to adjusted gross income, and now we're going to subtract the itemized or standard deduction and the 20% deduction for QBI. So first, of course, we're going to start off with itemized or standard. Now, we've already spent a lot of time on standard deductions, so we'll not spend any additional time here. You know what that is. So itemized deductions, it's medical, taxes, interest, charitable contributions, casualty losses, and miscellaneous itemized deductions. So if the total of these get over that standard deduction threshold, then you itemize. Otherwise, you go with the standard deduction. Now, the TCJA Act of 2017 changed the income tax law considerably. Now, it increases standard deduction, so very few people will be able to itemize. So in one sense, itemizing is less important than it used to be. However, your high income clients are the most likely to be able to itemize. And also, since fewer people will be able to itemize, even some high-income clients now won't be able to, it's important to be aware of ways to get deductions other than itemizing. So we'll mention that as we go through here. The TCJA changed tax laws, but many of those laws are set to expire in 2025. And so as you read through this material, you're going to see lots of references to that it'll revert back to the way it was at 2025. Now, for our purposes, do not worry about that at all. Don't learn it. Just, you've got enough to learn. So do not worry about learning the pre and post TCJA laws. Okay, one thing you will see referred to in this material is a tax benefit. So what exactly is that? So let's look at an example. Mrs. X, she can itemize. She is in the 37% bracket. She decided to make one more charitable contribution of $10,000 for the year. Now, this contribution decreased her taxable income by an additional $10,000, so her tax benefit was $3,700, which is 10% times the marginal bracket that she's in. Okay, so when we say the word tax benefit, really what we mean is tax reduction. She got a tax benefit here of $3,700. But let's look at another example. Mrs. Y cannot itemize. She too is in the 37% bracket. She decided also to make a $10,000 charitable contribution anyway, but her tax benefit was zero. That's because the contribution did not reduce her taxes. She couldn't itemize. She was going to take the standard deduction anyway. It didn't reduce her taxes, so she got no tax benefit. So, I ask you the question, are these items really deductible? Because, you constantly see in tax tips, oh, taxes are deductible. Oh, charitable contributions are deductible. But actually, they will give very, very few people a tax benefit simply because, relatively speaking, few people will be able to itemize. However, as we said, it's important to understand these things because your high-income clients are going to be the ones most likely to be able to itemize. Now, don't forget that we're on the cash basis, which means deductions are taken in the year cash is paid, not the year the bill is received or the year the bill is for. So, if you got a bill for 2010 and you only end up paying the bill in 2019, then it's a potential itemized deduction or for whatever we're talking about in 2019. So it's the year the cash is paid. Okay, so when you're advising your clients about itemizing deductions, be aware of whether they will be able to itemize. You do not want to say, oh yes, make a charitable contribution, it will reduce your taxes, and then you find out it doesn't. So you don't want to be in that situation. Okay, the first itemized deduction we will talk about are medical expenses. Now there's a 10% AGI medical expense floor, so we'll just show some examples of what this means. Amy, she's age 65, has AGI of $100,000. She has medical expenses of $7,000. So how much of her medical expenses will count toward her itemized deduction total? Nothing, because 10% of her AGI is $10,000. Her medical expenses do not exceed 10% of her AGI. So when we talk about this medical expense floor, we mean that these medical expenses do not even start to count toward your itemized deduction total until they get over 10% of your AGI. And the ones that are under 10% of the AGI don't count at all. Okay, example, Amy, age 65, has AGI of $100,000 and medical expenses of $15,000. So how much of her medical expenses will count toward her itemized deduction? She's clearly over 10% of AGI. $5,000 will count toward her itemized deduction. 10% of her AGI equals $10,000. Her 15 minus her 10,000 equals 5. So that 10% of her AGI will never count toward, only the amount that is in excess of that will count toward itemized deductions. Okay, Rusico and Chris have AGI of $100,000 and medical bills of $25,000. So how much of their medical bills will count toward their itemized deductions? Nothing. Okay, deductions are on a cash basis. Just the fact that they are billed doesn't mean that they can get any kind of deduction for it. Now, on the exam, I'm not going to try to trick you with differences between the wording of bills and expenses, but this is just to uh, you know, go home, make you realize it's just the amount that is paid. And again, it doesn't matter what year the bills were for, it matters what year they're paid in. And of course, the problem with medical expenses is that if you're high income, you can probably afford to pay those medical bills, but they probably won't go over 10% of your income. If you're low income, you may have medical bills that are in excess of 10% of AGI, but a lot of times you're not going to be able to actually afford to pay them. So relatively few people will get an itemized deduction for medical expenses. Okay, but there are some ways that you can take medical deductions for above the line, and we've already talked about HSAs. And also, if you have any medical expenses you could put toward a business, do so. That's pretty rare, but not impossible. So income tax planning principles: if a client can pay for high medical bills, try to clump them into 1 year in order to exceed the 10% floor. Okay, so if they have high medical bills, don't spread them out over 2 years. If you can wait and pay them all in 1 year, it'll make it more likely that they can get over that 10% floor. And this is a client, well, again, if they can pay for them. Okay, remember, deductions can be taken for the year paid, not the year incurred, and take medical deductions above the line whenever possible. Okay, itemized deductions, taxes. And let me say here, I think this chapter is pretty straightforward in terms of reading, so be sure and check the book because we're not going to cover the whole chapter. But I just want to emphasize that this lecture is not meant to cover every aspect of these, so the book will be a good supplement here. So taxes are deductible. Now, one problem with deducting taxes, itemized deductions, is that now there's a $10,000 limit on how much you can deduct as taxes. So this is another reason why it's more difficult for people to itemize than before. So, again, is there a way to deduct taxes above the line? Well, not a lot. However, be sure and allocate business taxes to business to reduce your gross income. And if your home is used for business, allocate a portion of property taxes on the home to business use. But those deductions have really been curtailed. So use deductions to your best advantage. When possible, allocate property taxes used to business to reduce gross income. Itemized deductions, your home mortgage interest. Okay, so deductible home mortgage interest is interest paid on home acquisition indebtedness. And the acquisition indebtedness is the key word here. Acquisition means that you have a mortgage, uh, and the money you used was to actually acquire your home, construct your home, or substantially improve the home, like add a room, something like that. Now, this applies to two homes, so you can deduct mortgage interest, acquisition mortgage interest, to two homes, all right? So that's good. Not more than two, but to two you can. Now, here's the limit. Interest on a total of $750,000 of indebtedness is deductible. So, gosh, for two homes, high income clients, they may have more indebtedness than $750,000, but only the interest on the first $750,000 is deductible. It's important to explain these things to clients because the laws have really changed, and many people will not understand why they can no longer itemize or why they can no longer deduct mortgage interest and property taxes because they can't itemize. And there's more severe limits on them than there used to be. Anyway, now, interest on home equity loans or lines of credit, because when we talk about mortgage interest deduction, we're not necessarily talking about home equity loans or lines of credit. Now, what this is that you can get qualified to take out a loan based on the equity that you have in your home, not to purchase it necessarily, but based on the home equity home equity that you have. Now, the interest that you pay on these loans are deductible if used for acquisition. So, example, Albert borrowed against his home equity to pay off credit cards with a high interest rate. Is that deductible? No. Those of you who work in tax know that it used to be deductible, and so be aware of it. One strategy used to be to go ahead and take out a home equity loan to pay off those credit cards because the home equity loan interest was deductible, but it's not anymore, so don't use that strategy. Another example, Alberta borrowed against her home equity to add a room to her house. Is this interest deductible? Yes. So use deductions to your best advantage. Be aware of this $750,000 limit when estimizing itemized deductions for clients. And a second home might not provide additional tax or interest deductions for a client, because remember, even if you can deduct the home mortgage interest, there is a pretty low limit on the property tax deduction that can be taken. And when possible, allocate mortgage interest to a business in order to reduce gross income. So again, if you have an office in the home, part of that mortgage interest can be deducted against the business income. The next category of itemized deductions, investment interest. Now again, this lecture is not meant to cover everything, so read the pages in the book. As indicated, let's just make sure that we're all on the same page and you know what investment interest is. Here is what it is. An investment interest expense is any amount of interest that is paid on loan proceeds used to purchase investments or securities. So in other words, you're borrowing money in order to buy securities, and so you're going to be paying interest on that money. Now, investment interest expenses include margin interest used to leverage securities in a brokerage account and interest on a loan used to buy property held for investment. So, if you take out a loan to buy a rental home, that is property used for investment, and that will be deductible. That will be deductible from your rental income. So, be sure and don't tell a client that investment interest is deductible if the client can't itemize. So really that holds for everything. You've got to manage your client's expectations. So be aware if they can't itemize, you want to set them up to not expect to be able to itemize. Itemized deductions, charitable contributions. Now, here is a chart that is in your book, which is a very good chart. And once you learn how to read it. I mean, it's very, very handy. So you see the type of property donated. You see vacation for purposes of valuation for purposes of the charitable deduction. Ceiling for public charities, private operating foundations, and certain private non-operating I can't talk, non-operating foundations, and the ceiling for other private non-operating foundations. So, I think the book does a nice job of explaining what this ceiling for public charities, etc., these last two columns, what these things mean. So we won't go over them here. The type of property donated, there's some vocabulary in there that let's go over. So the type of property donated. Okay, other than cash. The first thing listed here below cash is ordinary income property and short-term capital gain property. Now, an example of ordinary income property is a painting done by the donor. Okay, so the guy who gives it is the guy who painted it. That is one example. Later on, we'll get a little more formal definition of what ordinary income property is, but this is sufficient for now. When we talk about short-term capital gain property, this would be, an example would be stock, which is held for less than a year and a day. Okay. It's still capital gain, but it's short-term capital gain taxed at ordinary rates. Okay, what is long-term capital gain property that is intangible? Intangible long-term capital gain property example, stock held more than a year. Nothing you can touch, right? Really. Okay, long-term capital gain property that is tangible. An example is a painting held more than a year. The donor is not the painter. Okay, so someone bought a painting, they're holding it for investment, they've kept it for at least a year. That is what we call tangible property. Of course, tangible means you can touch it, so tangible property, you can touch your painting. Okay, and then tangible, real property, long-term capital gain, real property. And that example would be a land or building held more than a year. Now, for the rest of the course, you're going to hear the term real property quite often. So real property, generally speaking, is a land or building, as opposed to something like a painting that is easily moved around. Kind of a basic difference there. Okay, most of the contributions that most of your clients will ever make are going to fall into this category right here. We're not going to really go over it. You can see in this chart it gives you the percentage of taxpayers' AGI. So in other words, there's a limit to how much you can deduct based on your AGI. Now you can give as much as you want, but there's a limit to how much you can deduct based on your AGI. So when when you're studying this, just be really comfortable understanding this chart and being able to work with this chart. One thing we're going to do now is we're going to contrast the contribution of short-term capital gain property and long-term capital gain property, just simply using the valuation column for these. Okay, so example. Ulysses held stocks with a basis of $5,000 for 9 months. He gave them to a charity when the fair market value was $20,000. So he had very good intentions and he did a lot of good with that money, that donation. However, his charitable deduction is only $5,000, even though he gave them something worth $20,000 to them. Okay, because notice that the valuation for purposes of the charitable deduction is the lesser of the adjusted basis or the fair market value. And so here, the basis was much lower than the fair market value. On the other hand, we have another client. Nakia held stocks with a basis of 5 months for $5,000 for 13 months. So she gave them to a charity when the fair market value was $20,000. Her charitable deduction is the full $20,000 because look there, the long-term capital gain property for intangible property, the valuation for purposes of charitable deduction is the fair market value. All right. So of course, the lesson here is to give long-term appreciated capital gain property and not short-term appreciated capital gain property. Okay, charitable contribution, the limit on deductible contributions. So your client made charitable contributions of $2 million. Nice going in X1. Now, his AGI limit was $1,500,000. So he could not deduct the remaining $500,000 that year that he gave it. Not happy. Okay. But you're going to save the day. You tell him, don't worry. We can include the $500,000 in next year's itemized deductions. Contributions over the limit are carried forward for up to 5 years. So there's a difference between the deductibility limit, for how much you can deduct this year and whether you can ever deduct it or not. You can carry that amount forward to years when maybe they're under that deductible limit. All right, so you've done good by your clients. Now, many people are not going to be able to itemize, as we said. Now, reducing gross income with a charitable IRA rollover. So you have a client who has reached age 70 and a half, who will have to start taking required minimum distributions from her traditional IRA. Like most people, she doesn't have a basis in her IRA, and so the withdrawal will be included in gross income. It will be taxed at ordinary rates. She's in the 35% bracket, so ouch. Furthermore, the withdrawal will increase her AGI and make her subject to some deduction phase-outs. So what hurts the most is she doesn't even need the money to live on. This is one problem with traditional IRAs. Clients may have to take the money out and include it in income even though they don't really need it. Is there anything you can do for her? Well, sure. There is a charitable IRA rollover that people can take, and please read the article linked in eCampus and find out about how this is going to work. Linked in eCampus. Okay, so make sure your clients are aware of the deduction limits so that they are not expecting higher deductions than they will receive. Keep harping on that. Carry over unused charitable contributions that were over the limits, and have clients contribute long-term capital gain appreciated property to avoid tax on the gain. And a charitable IRA rollover will reduce gross income. This allows clients to take advantage of an exclusion income for a charitable contribution, even if they can't itemize. Okay, now let's talk about itemized deductions, miscellaneous itemized deductions. Now there's two types of itemized deductions, those that are deductible without limitation and those that are subject to the 2% floor. The 2% deductions, as number 2, were eliminated by the TCJA of 2017. So we're just only going to read about miscellaneous itemized deductions at number 1 right there. So don't go looking thinking, well, what the heck are those 2%? They don't exist now. Maybe they will be reinstated in 2025, but we'll worry about that later. Okay, itemized deductions clustering. Now, clients whose itemized deductions are close to the standard deduction are good candidates for clustering. So let's see what that means. For example, Eleanor and Franklin have the following possible itemized deductions each year. Sales tax, $7,000, property taxes, $9,000, mortgage interest, $5,000, charitable contributions, $7,000. So assume the standard deduction this year is $24,000. So can they itemize? So add these up and think about it. Well, no, they can't because taxes are limited to $10,000 per year. So the itemized are less than the standard deduction. They have sales tax of $16,000 total, the sales tax of $7,000, property taxes of $9,000. So they have possible itemized deductions of $16,000, but it's limited to $10,000. So they are less than the standard deduction. Now, here's an example of what we mean by clustering. If they don't cluster, they just go ahead and pay everything each year like they've been used to. So the sales and property taxes deduction is going to be $10,000 in each year. They pay $5,000 mortgage, interest in each year. Charitable contributions, they begin $7,000 every year. So each year their itemized deductions total 22. So each year they're going to take the standard deduction. So over a 2-year period, they will be able to deduct $48,000. Now, let's do clustering. And what clustering means is you try to push 2 years worth of deductions into 1 year. Sales and property taxes and mortgage interest are the same in the last example because those are difficult to cluster. The taxes most people anyway, it's difficult because of that $10,000 limit. If your taxes are under $10,000, maybe you can cluster them, but that $10,000 limit makes it really difficult to cluster property taxes. Mortgage interest, you can prepay a little bit, but it's difficult to cluster mortgage interest. Charitable contributions, however, you can push 2 years worth into 1 year. So as you can see here, that's what they did. They gave nothing in year 1 and they gave $14,000 in year 2. So in year 1, their total itemized deductions were 15. So of course they took the standard deduction. In year 2, their total itemized deductions were 29,000, and so of course they itemized. So over the 2-year period, they got a total deduction of 53,000 rather than the 48,000 if they did not cluster some of those deductions. So cluster itemized deductions when it's advantageous, when it would give, if it would increase their deductions to maximize the below the line deductions over a 2-year period. Okay, and the last deduction that's below the line is the qualified business income deduction. Again, I'm not going to go over it here in the lecture. I want you to read about it. But one thing I want to note, just to make it clear, is that this QBI deduction applies to pass-through entities, not C corporations. So recall those pass-through entities are partnerships, some estates and trusts, C corporations, not C corporations, S corporations, LLCs. Those are the entities whose income shows up on the individual tax return. Those entities do not file their own tax return and pay taxes. They do file a return, but they don't pay taxes with that return. Now, the QBI does not apply to C corporations. These are the corporations that do file and pay their own income tax returns, and their income is not passed on really to the owners, so to speak. Okay, so use deductions to your best advantage. The QBI deduction is subject to phase out based on AGI. So businesses who are in that phase-out range may want to increase business deductions for the year to the extent possible. So you're on cash basis, for example. If you are in the QBI phase-out range, you may be able to accelerate some expenses into the current year to get you under that QBI phase-out range, or even reduce where you are in the phase-out range.